Hey everybody, Matt Graham, MBS Live here with you on Monday, March 3rd, 2020. More crazy time for bonds. Here's a chart that I put together for MBS Live earlier today. Just highlighted some of the movement we've had on a 1-month candlestick chart of 2.5 coupons. For everyone who's asked, 2.5 is the only place to be watching right now. 3.0 coupons are liquid, but 2.5s are much more related to rate sheet movement to whatever extent MBS prices are even relevant to a lender's rate sheet past a certain point right now. And for many lenders, they're not. In other words, once prices are up to a certain level, pricing is determined more readily by capacity and other factors than by moving rate sheets in line with MBS movements. It's neither really here nor there, just answers a question that seems to have been coming up in chat quite a bit. Anyway, as you can see on the chart, right, each successive week has been crazier and crazier, and now today has traversed as much ground as the entirety of the most volatile week ever, which was last week. It's nuts. The Fed made an emergency announcement today, and a couple of them for that matter, and did several things. Here's one of them. It talks about new total loss absorbing capacity and new temporary lending facilities. These wires, news wires, tell a little bit more of the story, but they're going to announce a Main Street business lending program and money market liquidity facility, asset-backed security lending facility for student loans, auto loans, credit cards, small business administration, new programs to support credit flow for businesses, new facilities to provide blah, blah, blah. The list goes on. I could read the rest of those words, but it's pretty boring. It just means that the Fed is going to be damned if they're going to let liquidity get in the way of whatever it is the market wants to try to do to fight back against the coronavirus correction, recession, depression, whatever you want to call it. Big, nasty hit to the economy from coronavirus. We need to just get over the fact that that's a given. And then the market is going to try to do whatever it can do to push back. And liquidity is at a premium because everybody's terrified. Everybody has to make adjustments to account for the slowdown in the flow of money. And the Fed is really it as far as guaranteeing that money can continue to flow freely. So when we ask things like, with the Fed doing all this stuff, and by the way, they announced $50 billion a day of MBS buying, and basically worded it in such a way that they can more or less buy it as much as they need to support liquidity in the MBS market. We can talk about that in more detail later. It's not even really that important. We knew that the Fed was going in this direction and that they would continue to rage like the Hulk and try to turn the bond market green with everything they had, and they wouldn't really stop until the mission was accomplished in terms of liquidity. So massive Fed bond buying, as much as the bond market needs. That's why Fannie 2.5 or UMBS 2.5s are well over par now, whereas par was kind of like this maybe scary level at the end of the past few weeks. Over 102 right now, over 103 for much of the day. That's insane. It's going to take time for it to, be very stable in that neighborhood. So just even closing above 102 right now is a big deal. So with the Fed doing all that, why isn't there a more evidence or more reaction in the broader financial market? Why aren't stocks responding more enthusiastically? And the very simple answer is this: is the first thing we said from the beginning of all this, Fed intervention is the Fed can't wave a magic wand and make the stock market go back up. Having access to cheap money isn't going to heal the economy or prevent a recession, depression, whatever. It's just going to make sure that whatever we're entering into isn't exacerbated by a credit crunch and a liquidity crunch. It's not even really that the Fed is trying to keep interest rates low to stimulate economic activity. They're just getting out of the way, or trying to have financial market get out of the way of itself, really, because if the Fed wasn't there, lending would really have been shut down by now, and things would be much worse, and big companies would be going out of business if they were very much involved in consumer lending or interbank lending for that matter. And the Fed is just making sure that kind of stuff doesn't make an already crappy situation even crappier. So that's why the stock market isn't bouncing. And that's why the Fed is doing what they're doing. And that's why we're not instantly seeing, 10-year yields down near 0% or mortgage rates at 2.5 despite all this crazy Fed buying. There has to be bonds generated for the Fed to buy. There has to be supply on the market for them to scoop up. And they're just making sure that it gets bought either by them or, by them, really. So that's the new reality of market movement in this environment is insane volatility. We're going to see instances like we did today of MBS prices moving up, 2-3 points and then down a point. And then that's just kind of the way it is. It's a factor of very, very, very tight liquidity. It's improved from where it had been last week and the week before, but it is still not great. Low liquidity means that trading levels can move lightning fast between level to level. In a normal environment where mortgage lenders are very well tied to MBS prices, that would result in a ton of negative reprices. We had quite a few today, but quite a few positive ones as well. And reprices continue to be driven just as much by lender capacity. Some lenders are paying some attention to MBS, but realistically, capacity is just as big of a deal, especially for the ones that are, operating most efficiently right now. So anyway, just be aware that volatility is a way of life. Lender-to-lender discrepancies are humongous, as big as we've ever seen them. Lender price changes are gigantic, much bigger than changes in MBS would suggest in cases where, we have one rate sheet timestamp versus another one, compare those two rate sheets, and then compare the difference in MBS prices. Oftentimes we're seeing lender rate sheets move much more than the market is suggesting they move. And that is basically the lender's way of saying, okay, we're accepting refi apps and now we're not. That simple. If you are with a lender that has a rate up at like 4.125% for a super perfect 30-year fixed, understand that that is not nearly as far out of the market versus 3.625 as it would seem. Reason being, very many large lenders right now are priced excruciatingly closely to 3.625 on a 4.125% quote. They're very close in price. It's never usually the case because things are usually more stable and not moving toward lower rates so quickly. But when that happens, the value of those higher coupon MBS, the coupons that 4.125 would go through the floor. Nobody wants to hold those things because people assume they have a lot more refi pool left to refinance. Early payoffs or earlier than expected payoffs via refinancing hurt the value of those premium priced coupons and then make investors want to pay less for them on the open market. That makes lenders less able to price them aggressively when it comes to creating rate sheets. So you're not going to see decent pricing on anything with a bunch of LLPAs or anything in the higher rate range for whatever reason. And that's just the way it is. It's going to take time for that to come back in. Time and stability have been the two names of the game ever since things got crazy. It was always going to take time and stability, both in bonds and MBS, for lenders to be able to tighten rates up to MBS prices and for MBS to be able to tighten up to treasuries. Time and stability. And the stability is a reference to, general bond market stability or economic stability. So in some regards, that stability aspect could be a long way off, but the stability in treasury yields could settle down as soon as we get more in tune with what the economic reality is going to be, what the issuance amount from this projected stimulus is going to be. And by the way, it's not $4 trillion that they're going to issue. That 4 trillion number over the weekend had to do with Mnuchin quoting liquidity measures from the Fed, which is not new Treasury issuance. They're going to issue a bunch of treasuries, the White House is, or the administration is, but it's not going to be that 4 trillion. Maybe 1 trillion, 1.5. I don't know. I haven't even looked. I know that the Senate bill got delayed again today. And once that passes, we'll see exactly what the issuance is, but it's not a big linchpin for Treasury yields. I think, we're in a range between something really, really low, maybe 0.3, 0.5. I don't know where the lower bound's going to be for a while. Somewhere between there and the previous lower bound of 1.3. And we may move around in a volatile fashion in between those boundaries. But it does seem, looking at a longer term chart here, it does seem that we sort of topped out right around 1.3 there on the 18th. Anyway, locking or floating depends a lot on what your lender is offering. If you're seeing stuff down around 3.25, 3.375, I don't think there's a whole lot of harm in taking that off the table. If the client's thrilled with it, could rates go lower? Absolutely. I mean, with the Fed buying as much as they are, rates could definitely go lower. Are they going to go lower soon enough for that client to take advantage of it? Couldn't tell you. Definitely also a distinct possibility. But the country could shut down in such a way where even if we, get everything sorted out in terms of e-closings and whatnot, it could delay the closing process enough to blow that lock, and then things could be in jeopardy. So in this uncertain environment, there is more to be said for grabbing something and locking it if it's good enough for all parties involved, as opposed to trying to squeeze every last eighth of a percent of interest lower out of a certain attempt to float and improve there. So you'll have to make those decisions with your clients. I would involve them in those decisions, make a game plan, find out what they're happy with, lock it when you see it. And if you have clients that don't really care, super risk tolerant with a long-term outlook, yeah, there's definitely a possibility rates could continue to go lower. Obviously, we are heading into a massive economic contraction, recession, depression, whatever you want to call it. And that connotes lower rates, even in spite of the massive issuance that is coming our way in the treasury market. So yeah, bottom line, not taking things for granted as far as what rates are going to be available, but still reason to hold out hope if you are nimble and super risk tolerant. That is going to do it for today. Back with you guys tomorrow. Have a great rest of your day.